Hey everyone, welcome back. In today's episode of Stock Secrets, I'm going to teach you a classic strategy that doesn't require any technical indicators at all. Using nothing but a daily price chart, I'm going to show you how you can accurately predict the direction of the market 75% of the time using this strategy. Also in today's video, I'll answer some questions about the strategies I presented so far, and I'll also show you how to quickly execute any of the strategies I've released on whatever ETF or stock you're currently trading. So please stick around because today's video is going to be great. The commenter says, 80% win rate for 30 years means beating the market. Bout it. Okay, so let's unpack this statement. First of all, you need to understand that the win rate a strategy has nothing whatsoever to do with its profitability. Please remember, if you enjoyed this video or any of my research on YouTube or the website, please let me know by subscribing, liking the video, and writing a comment. If you're new here, we have 3 ongoing series on the channel. The first is Portfolio Analysis, where we dig into long-term, mostly passive portfolios. The next is Retirement Planning, where we cover various financial independence and early retirement topics. And finally, we have Stock Secrets, where we dig into active management and trading strategies.
That's my quant.
Your what?
My quantitative. My math specialist. Look at him. You notice anything different about him? Look at his face. I'll give you a hint. His name's Yang. He won a national math competition in China. He doesn't even speak English. Yeah, I'm sure of the math.
Here's a comment that I got regarding the basic Bollinger strategy that I shared back in February of 2021, where somebody had asked me this question. The commenter says, am I reading this right? This strategy returned 22% total over 10 years? I backtested stuff like this a while back and never found it to be profitable. Okay, so first of all, the statement, I backtested stuff like this a while ago and never found it to be profitable, implies a lack of understanding when it comes to the purpose of backtesting. You should never actively trade the markets without the probabilities data and historical evidence that proves that your strategy actually works. If you don't have a backtest that shows your profitability, then you might as well just be pulling a lever on a slot machine. The reason why 90% of all active traders lose money is because they misunderstand the game entirely. If you learn nothing else from the strategies in my Stock Secrets series, please remember this. If you don't have an edge, or you can't prove that edge with mathematical probabilities, then don't actively trade your accounts. Period. As for the strategy returns, I get how you might see this 22% over the last 10 years and be unimpressed. This calculation here isn't valid for our purposes. You're trying to compare long-term buy and hold returns for assets that are 100% invested all of the time at full market beta to individual trades that last anywhere from 1 day to just a few months. To get a better understanding of why this is, let's evaluate the trades that were placed. We're actually currently in a trade right now, but if we look at the previous trade, we see that it lasted just over 2 months and returned 14%. So in that case, that's 7% per month that you got worth of returns on the one trade. 7% is what you could typically expect in an S&P 500 index fund over the course of an entire year. The trade prior to that trade lasted for almost 3 months and it lost 1.5%. However, from this point upward, as we go back 9 years in time, every single trade that was signaled by the strategy ended up producing a winner. So if you really want to understand risk and returns, you need to compare the amount of time that your money is deployed versus the returns you received. In other words, you were in the market only a tiny fraction of the time, yet the returns that you received for that reduced risk exposure was massive compared to a standard buy and hold where you put all your money in and leave it there for 30 years and ride all the ups and downs. Here's another comment that we got regarding the RSI Power Zone strategy. The commenter says, 80% win rate for 30 years means beating the market. Bout it. Okay, so let's unpack this statement. First of all, you need to understand that the win rate a strategy has nothing whatsoever to do with its profitability. Let's take a look at this options trading challenge that I'm currently participating in to illustrate this idea. So far in 2021, I have closed 44 trades in this challenge, 36 wins, 8 losses, and an 82% win rate overall so far. Now let's imagine that you placed 20 trades. 4 of those trades went against you, and like me, you didn't properly manage these trades, so they blew up and expired worthless. You lost $325 on Dollar General, $387 on Qualcomm, $620 on Walmart, and $416 on Apple. These 4 trades alone resulted in a loss of $1,750. Let's pretend that all your other 16 trades are winners. Congratulations, you've recorded an 80% win rate. You're doing better than the vast majority of traders. However, you somehow managed to lose $100 in your account overall. How is that possible? How did you manage that? Well, those 16 other trades that were all winners turned out to average just about $95 each. One of the most critical concepts that you have to grasp when actively trading the markets is that position sizes are critical to your long-term survival. I don't care if your strategy has a 95% win rate if a few failed trades undo all of your winners and blow up your account. As for the trading challenge, participants were limited to $5,000 total capital, and they could use any strategies that they wanted to. As of March 2021, that account is up around $2,000, so that's a total return of about 40%. Using these strategies is fairly simple. Start out by navigating to the Journeyman website, and then filter the post by stock strategies. Find the strategy that you're interested in and click into the post. At the bottom of the post will be the complete source code. So navigate to the bottom of the post, and then you're going to want to highlight all the code. Be sure that you highlight it exactly and that you get all the code in gray. And right click and select copy. Then you want to navigate over to tradingview.com. Click on the chart link in the main menu. Then change the security from Apple to SPY and select the S&P 500 as your symbol. Then click the Pine Editor window and delete any source code that's already there. Control V to paste in the code that you just copied from the blog and click Add to Chart. If you're not yet signed in, you'll need to go ahead and sign in now. Once the sign-in process is complete, then the strategy will be applied to the selected chart. Once the strategy has been applied to the chart, you can view the statistics. Here we can see we have a 93% win rate for the strategy. If you click the List of Pains tab here, you can actually break down each individual trade that occurred in the strategy. If you want to change your settings, navigate up to the indicator and click the settings wheel. Here we're going to change the start year to 2015 just to demonstrate the change. Click OK. Notice your win percentage went up a little bit there. And you can change this to any security that you like to see how this strategy would perform against various marketplaces. Today's strategy is called Double Sevens, and most traders who have been in the game for a while know this one. It's based on this idea that when it comes to index ETFs, they tend to do much better on breakdowns as opposed to breakouts. Double Sevens is one of those classic buy the fear, sell the greed strategies. A word of warning here though, this strategy is only for trading index ETFs that are in a long-term secular uptrend. Don't go trying to trade Rocket Mortgage or Workhorse or Palantir or some shit with this strategy. If there's any chance that that stock can go to zero, then you don't want to go anywhere near it with double sevens. The rules here are really simple. Rule number 1, the SPY ETF must be trading above its 200-day moving average. Rule number 2, when the SPY closes at a 7-day low, enter at the open on the following day. And rule number 3, when the SPY ETF closes at a 7-day high, exit the trade. As usual, I don't recommend buying shares with any of these strategies. To get the best results, you really should be using options. You're going to need to decide what makes the most sense for you, whether you should buy high delta leaps calls, should you sell a cash secured put, or should you buy a debit spread. Only you can make that decision. Alright, so let's execute this strategy. The default range that I programmed into this strategy is January 1st of 1990 through December 30th of 2022. Feel free to change this range all you like using the strategy settings, which you can find up here. This strategy triggered 271 buy signals and had a 75% win rate. Maybe not as high as some of the other strategies, but this strategy triggers a lot more often, so you have a lot more chances to participate. If we open up the list of trades and scroll to the most recent trade, we can see that we're actually in a trade right now, as of Monday, which was March 22nd, 2021. Looks like the last failed trade that we had was back in September of last year for a loss of about 3.5%. The return percentages here look fairly low in the 1 to 3% range, but remember that these percentages are based on you buying shares, which you shouldn't be doing. If you had sold cash secured puts, for example, instead of buying shares, your profitability would have been through the roof. Never forget that identifying exit and entry points is just half the battle. The other half is picking the correct trade to put on. Okay, so this looks really good to me. If you wanted to change some parameters, I've exposed the double variable here. Feel free to toggle this range from 5 days through 10 days and experiment with the results.